I'm Mary Lyons, the Wealth Woman.
And I'm Eric Alexander with Benchmark Income Group.
Welcome to the Big Wealth Podcast. If you were with us last time, we talked about how you can fund a whole life insurance contract, all the ins and outs. And this time, we're going to talk about how you can stop funding or get out of a whole life insurance contract.
Getting in and the getting out.
Exactly. If you are anything like me, you love a good opportunity, but anytime I am considering getting into something, I need to know my exit. And if I have multiple exits for different scenarios prior to writing that check. So today we are going to talk a little bit about the different ways that you can stop funding or get out of a whole life insurance contract. So Eric, do you want to start with the first one, the natural offset?
The natural offset. This is sort of the culmination of what we want to go do as we get into retirement. No, as you mentioned in the last podcast, no one wants to go, I'm retired, but I've still got to write this stupid mortgage payment for the next 17 and a half years of my life, or the stupid premium payment. And so in a natural offset, the kind of the genesis of what's going on there is you have enough dividends that are being paid from the growth in the policy, plus the PUAs, the paid up additions, and you have enough of those kind of running in the policy and enough growth there that you could stop writing new premium checks, and the policy is basically paying for itself. The dividends and the paid up additions are going back in to make sure that that base premium, that mortgage payment, is still being paid, but it's not coming out of your checking account. And so that is one of the first, and sort of that is always the ideal solution, is that you walk into retirement, whether that's 55 or 65 or 80, and you turn off the life insurance policy, it sustains itself, and you rock and roll.
And the one thing I want to point out about the natural offset is that you don't want to try and do it too early, because it is based on assumptions in terms of the dividends that are being paid out. So even though a policy could offset, in this example, let's just say it's in year 7, that doesn't mean you should offset it in year 7. You might actually want to wait until year 10 or even year 15, just depending on what your plan actually is. So,
but emotionally on that, before you jump in, I always love knowing that I could stop it at year 7. There's a huge component at year 8. It's like, I'm writing this check because I want to make my future better, not because I'm on the hook to the stupid insurance company.
Right. I think that's a really good point. So the second way that you can stop funding an insurance contract, at least for a shorter period of time, or change the way you're doing it, is just by pushing the pause button. And so what you can do is you can temporarily offset the contract in this situation. So a temporary offset is very similar to a natural offset, except you're only going to do it for a year or 2 or 3 years, depending on what you actually need or how long the policy could actually do it. And that's going to be based on how you funded it to date. And it will also be based on the current dividend scale. So if you have not overfunded a contract, doing something like this is going to be harder than if you aggressively overfunded a contract, because you have a bigger cushion from which to pull the premium payments, because it is a combination of both the dividend and the paid up additional insurance funding. So,
and it's funny because I'm actually doing that right now. I turned mine off for a couple of years for Broken Bow and some of the other stuff we're doing, and it's great because on the anniversary I reach out, I turn it back on, and we rock and roll. It's a neat way to kind of have that safety valve.
So Eric, let's talk about number 3, which is a partial offset.
Right. Yeah. So that's one of the other cool things about it, especially if you've overfunded it correctly and you have that heavy buildup of cash, is you have the ability to really, really drive that back down. And so one of the easy ways to go do what I would call a partial offset, and there's a further into this, is I just want to turn off the paid up additions. I'm used to paying 10 grand a year. I want to take it down to $2,500 a month because that's my base. I want to turn off all the other stuff. Right. A year.
You went from 10 grand a year to 30 grand because you said 2,500 a month. I'm sorry. I couldn't help myself and I had to point that out.
Hey, what's a weird unit of measure between friends?
I tried to hold it back, but I couldn't. So.
Yeah, we're going to talk about Celsius and Fahrenheit here in a minute. But yeah, so 2,500 a year. So you have the ability to turn that down. And then again, to your point earlier, you can turn that back up. And so to me, that is a partial reduction, partial offset. But you also have, like Mary talked about earlier, with just a partial pause, is you have the ability to turn off and turn down some of the base premium as well, and have some of that relief, and then have the ability to turn that back up.
And so that base premium is actually still contractually due. You are just
Right.
changing the way the dividend is credited. So
Correct.
rather than having the dividend actually go into the cash portion of your policy and to buy paid up additional insurance, you would just redirect the dividend to pay part of the premium. So if your dividend was $1,000 and your normal premium was $2,500 a year, you'd go from that 10,000, turn the paid up additions off, and then apply $1,000 of the dividend to the
Right.
premium, and you would only owe the remaining 1,500.
Right.
And so I actually had some clients do that when they went back to school. They had started a
That's a great
policy, and
point.
within probably the first 3 years of starting it, one of them decided to go to grad school. And so we just had the dividend pay as much of the premium as it could.
Yeah,
And so
we're talking about doing that with some missionaries right now
Mhm.
that are turning some of that down while they go do some of the mission work and then turn it back up.
Right, when they're back and earning at their normal level.
Yeah,
So I think
exactly.
that's a really good one. And then another option for how you can stop funding the insurance contract is you can do something called an RPU. That stands for reduced paid up, right? So
Right.
reduced paid up insurance basically says I've put a certain amount into the policy and it's grown to a certain amount. And let's say there's $100,000 in the cash value of the policy. Let's say you originally bought $1 million death benefit and you're like, you know what? I am never going to put another dollar into this. So an example of this happening to a client of ours at some point is that he had a job working for a private equity firm, and he was also teaching, and then he had a side hustle. And so he had well over $500,000 coming in. And then when we went through a recession, he realized that the way he was being paid by the private equity group was way different than market,
Right.
and his income dropped and he ended up going to be a professor. And so he went from $500,000 of income to 100,000 of income, which is still a wonderful income,
Right.
but the commitment he had made on the insurance side was no longer feasible. And
Right.
so what he said was, I want to keep everything I've done so far. I buy into this concept. I believe in it, but I can't afford to keep making premium deposits. And the policy was not yet in a place where you could do a natural offset and sustain it for into perpetuity.
Right.
And so what we chose to do was a reduced paid up policy where we took the $1 million worth of death benefit and we shrunk it down to about 200,000 of death benefit, and the 100,000 of cash value could have sustained that and did. And so both the cash value and the death benefit began to grow at that point. And not only was he never required to put another premium dollar into that contract again, but even if he wanted to, that's the downside of an RPU. You can't.
Right.
So
It's
that
a
one,
little
once
bit more
you turn it off,
catastrophic than
you
the other
can't
ones.
turn it on.
Yeah.
Right. But it's nice to know that you have an option where you get to keep what you've built, because if you kind of draw the parallel to
Right.
that in a mortgage kind of situation, if I can't make my mortgage payment ever again, I have to sell the house to get at the equity. I don't get to keep the part of the house that I've paid for. So if I've paid for the kitchen and the master bedroom, I don't get to
Right.
keep that and sell off the other piece.
That's
But
not how that works.
no, but this is a way that you can essentially keep what you've paid for on the insurance side.
Yeah.
And then I think you have one last option for how you stop funding a whole life insurance contract, and that's to surrender or cancel the contract. So Eric, will you
Right.
talk about that just a little
Yeah.
bit?
Yeah, that and the one that is the most catastrophic is just walking away. Like, I don't want to go do this anymore. And so the great thing on that one is whatever you've got in the cash value, that's yours to keep, right? You get that as the money on the exit from the contract. You walk away from all the death benefit. And then what happens is on the cash value, all of the money that's above your basis, which means all the money that's grown, that's above what you put in. So if you put in $100,000 in premium and the contract's now worth 150, that 100K comes back to you as a return of premium. It's tax free, and then you're only paying taxes on the growth on that side of it. But it's a way to walk away and get to keep what's left.
Right. And in that particular circumstance, you would actually pay ordinary income taxes on the growth in the policy.
Right. Right.
Right. So if there is a reason that you need out and you need access to it, it's good that you can do it, but that would always be the last choice, because even if you needed access to the money, had you done a natural offset or an RPU, you can always borrow against the policy, use the
Right.
money, and then replenish or pay it back at a later date, which is not a bad idea, because even if you had cash and you went and deployed it, you're going to replenish your cash. So this is just a holding place for your capital, and you can always replenish it as needed. But I think that it's really important to understand when you're getting into something, how you can get out of it, even if your
Yeah.
intent is to keep it forever, because sometimes life throws you curveballs. And when it does, you need to understand what your choices are. I've definitely seen, especially with other types of insurance, but I've seen this happen with whole life too,
Right.
where people can't make their premium payments and they just don't do anything about it. So let's talk about for just a second what happens in that particular scenario. If I just stop making
Right.
the premium payments, most contracts, but not all of them, have a feature called an automatic premium loan. And an automatic premium loan means that if I don't send my payment in within 30 or 60 days of the due date, depending on the company, they will automatically borrow from or borrow against the cash value of my insurance contract to pay the premium. So the insurance
Right.
company essentially is using their money to pay your premium, but they're now saying that you owe them that money at a future date and they will charge you interest on that money, which
Right.
is okay if you're planning to do it a year from now or 2 years from now. But if your intent is never to make another payment, what'll happen is they'll keep doing that until the loan amount is bigger than what you have in the cash value. And
Right.
when you hit that threshold where the loan amount exceeds the cash value, then the policy will cancel. And the danger of doing something like that is that at that point in time, when the policy cancels, you will still owe money on all of that growth that was in the contract, even though it never ended up in your pocket. And so
Right.
it is very important if you do think you want to get out of a contract that you actually call either your agent or the insurance company, or you work with somebody who is an advisor that can help you through this process so that you understand if there are tax consequences and you don't just walk away from it and think, I'm just not dealing with it anymore, which
Well, on the
shockingly
positive end
could
of that,
happen.
yeah, but the positive end of it, not to, just to put a negative or positive spin on it is, yeah, it was doing its APL, its automatic premium loan, and so you're not writing the check, but you've gotten the death
Still
benefit
have
the
the
whole
death
time.
benefit.
Yeah, you
Right.
had coverage the whole way, which is nice, and that's why they do it.
Right. Well, except that if you're doing it by default and you don't really know that you
Absolutely.
have other choices, I think that's where it
Absolutely.
becomes an issue, right? And some of that I think is a problem with the insurance industry because it does have a high degree of turnover. And so it's just important that if you do decide at some point in time, hey, this permanent insurance contract is not for me, that you have a resource that can help you figure out what choice you should be making without and that you understand the impact from a tax perspective, from a
Right.
cash perspective, but also from a long-term impact to your retirement perspective. And so we just wanted to make sure you understood what your outs are. If you have questions, you can find me at The Wealth Woman. Eric, where can they find you?
You can find me wherever you use social media at Economics with Eric.
Thanks for joining us.
Thanks.